SoFi stock price has been on a tear here in 2025, rising significantly. And of course, I'm happy about that. I've had SoFi stock rated as a buy for most of this year, and I've changed my recommendation during certain times. And I'll share with you my updated ranking on SoFi stock, whether I think it's buy, hold, or sell. But first, I wanted to talk about why everyone is so excited about SoFi stock, the underlying fundamentals that are lifting share prices higher. Let me share those details with you in this video. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. SoFi CEO Anthony Noto talked about the drivers of their durable growth, starting with a record 905,000 new members added in the third quarter, increasing total members by 35% year over year, which was a slight acceleration to 12.6 million SoFi members. SoFi also added a record 1.4 million new products, representing an acceleration in growth to 36% and over 18.6 million products. Cross-buy reached its highest levels since 2022, with 40% new products opened by existing SoFi members. And this is an important thesis for the long-term bull case for SoFi stock investors. SoFi wants to be everything you will ever need financially in your, whether it be a home loan, a student loan, a car loan, a personal loan, a credit card, investing advice, investing trading services, a financial coach, whatever you might need in your life financially, SoFi wants to provide that service. And incrementally, they've been moving forward with that plan, adding new products almost every quarter, launching new services almost every quarter. In the recent quarter, for example, they added level 1 options trading availability. They also added or re-added, they had this before, but the ability to buy, sell, and hold cryptocurrency assets on the platform. So incrementally, they continue adding services, and members of SoFi value those services, and they keep joining and they keep adding incrementally as they find these services valuable. And underlying all of this is the digital only strategy from SoFi. And I expect, sometime down the line, if they keep growing the way they're growing, and let's say 10 years later, let's say they have, instead of 12.6 million members, they have 50 million members in the United States, I can see them adding some locations, some brick and mortar locations after they've grown to large scale. But for now, I think they will stick to this digital only strategy, which is a competitive advantage, in my opinion. And I've talked about this extensively, why legacy banks have underinvested in their brick and mortar locations, creating an opening for a company like SoFi to come in with a digital-only service and capture significant market share. Overall, adjusted net revenue came in at $950 million in the most recently completed quarter, which is up 38% year over year. That was an acceleration from the previous quarter, and SoFi has demonstrated better than expected revenue and profit growth here in 2025. That's partly the reason why the share price is up as much as it's up year to date this year. Together, their financial services and technology platform segments generated $534 million in revenue. That was up 57% year over year, and it now represents 56% of total revenue. SoFi, similar to Tesla, wants to be known more for its financial services and technology platform because those segments generate a higher valuation from investors. And if you've been following Tesla stock, you know Tesla's been trying to sell that story of being an AI company because AI companies boast a higher valuation than car companies. And so Tesla's trying to convince investors it's an AI company, and SoFi's trying to convince investors it's a financial services and technology company, not a bank, not a lending company, because banks and lending companies boast lower valuations. I will say that SoFi has been more successful in this matter because a larger percentage of its revenue is coming from these segments that it wants to be known for, whereas for Tesla, still more or roughly 80% of its revenue is coming from car sales. And so it's still largely dependent on car sales. It's still 80%, whereas with SoFi, the lending and bank segment is less than 50%. So it's progressed more towards identifying itself as this type of a business compared to Tesla that's also trying to sell this story to investors. So the lending segment has been a superstar, even though SoFi is trying to move away from that, but it's the way it's approaching the lending segment that's been very lucrative for SoFi stock investors. Adjusted net revenue for lending segment increased 23% to 481 million, driven by strong originations in this segment to 6.6 billion, combined with the very strong $3.4 billion of originations in the loan platform business, with total originations reaching 9.9 billion. That's an increase of 1.2 billion. Now, what's important here is the loan platform business. And I'll explain that a little more so you can understand a little better why this is more lucrative than the way SoFi historically has been lending. Historically, SoFi makes loans and then holds them on its balance sheet and services these loans. And if somebody doesn't repay, SoFi's on the hook for those losses. It also has to use capital to make these loans. It has to use its own capital or warehouse lending services capital to make these loans. And so it ties up capital, meaning it's a capital intensive. Every time SoFi makes a loan, it has to use large amounts of capital for each loan. Now, with the loan platform business, SoFi is able to leverage its loan origination services, right? It knows how to conduct due diligence and the process to originate a loan, customer acquisition, etc. But then it doesn't keep the loan on its balance sheet. It originates the loan and then sells it immediately to a third party, a lender that wants to purchase this loan immediately and absorb those risks, whether the borrower repays or doesn't repay. The third party lender is on the hook for that loan. And SoFi gets to originate the loan and generate the fees for originating the loan. And oftentimes, SoFi contracts with the party that it's selling to so it can service that loan and earn a fee for servicing the loan, collecting payments, processing payments, calling the borrower when they miss a payment, reminding them to make that payment. Those are services, lending services that SoFi also sometimes sells to these third parties. So it's a lot more lucrative, higher profit margin revenue for SoFi, lower risk revenue for SoFi, and also capital light, which allows SoFi to grow without being constrained by the amount of capital it can access to make these loans. So this is why this segment has been incredibly lucrative for SoFi. And I believe this is the primary reason why SoFi stock is soaring as much as it is this year. This has been a relatively new opportunity that's really thriving, and third-party lenders demand for these loans is soaring. And I can see this from other businesses that are offering similar sales of loans to third parties. They're originating and selling, and buyers for these kinds of loans or in, I mean, I'm surprised at how much lenders are interested in purchasing these loans. Their optimism for the payback is, I think, a little bit too high, and we'll see this in future quarters and future years. If the defaults from these originations are higher than these third-party lenders were estimating, but the return on investment they're getting is also attractive. If you think about the average rate on the personal loan that SoFi originates, it can be 12 to 13%. So if you compare that with, let's say, purchasing a government bond, the US government bond, the 10-year bond will give you about 4.1%. So you're getting about 3 times the rate that you would earn investing in the US government bond. And of course, you're getting that extra rate of return because you're taking a lot more risk by investing in personal loans instead of investing in US government bonds. So in my opinion, this is one of the main reasons why so many investors are excited about SoFi stock and why SoFi stock is soaring as much as it is. However, I think SoFi stock has gotten a little bit ahead of itself in terms of the stock price increase compared to the increase in fundamental performance of the business. You see here my proprietary discounted cash flow valuation values this stock at around $19 a share, that the current market price is over $30 a share, $31 a share. That's why a couple of weeks ago, I downgraded SoFi stock from a buy to a hold. I'm still bullish on the long-term prospects of this company. However, at the current market prices, I think there are better risk versus reward available in the market for other companies right now. So after the stock price was up, I think 85%, I had SoFi stock rated as a buy all year up until it was up about 85%. At that point is when I felt the valuation was too stretched and I downgraded it to a hold, which is where I have this stock rated today. I have SoFi stock rated as a hold. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.